data and figures and statistics. Just to give you a flavor on, to build on what the minister said, how impact investing and how the financial sector can help on growing that sustainable finance topic. I'm Frédéric Venner, I'm a partner in the regulatory advisory practice at PwC in Luxembourg, and I'm leading our sustainability and sustainable finance practice. And today I have the pleasure to be with my partner, Dariush Yazdani. Dariush, you're leading our global AWM and ESG Market Research Center, if I'm right. And you've been at the forefront of a global report that we just issued, a global report that you can find online, and we'll give you today some of the key hints and the key figures that we believe are important in the context of sustainable finance. That global report has been made by interviewing 250 asset managers globally and 250 institutional investors globally also. And if I just need to check where do we have a Zappet or? Zappet is a technical term, you know. Thank you. Just checking that it works. Here we go. So you have the name of the report now showing on screen. It's what we believe is exponential. It's the exponential expectations towards ESG in the AWM, in the asset and wealth management industry. During the 40 minutes that we'll spend with you this morning, as said, we'll try to go through the key components of the report. We're happy to take some questions at the end of the session, if you don't mind, whether people from the audience here in the room or people online. And anyway, we'll be happy also, Dariush and myself, to take any further questions you might have offline. You're going to have our contact details at the very end of the session. The report, Dariush, has been built around four building blocks, 4 topics. The first one is what we believe, what you believe, might be the AWM landscape by 2026. The second topic in the report is around what we believe are 10 ways that ESG will be shaping our future. And I have to turn because so that I don't know by heart the name of the third section. Third section is about how you, asset managers in the room and online, should adapt your business. And the report closes with 10 actions, very hands-on, practical, that you might consider also to make sure that your business is sustainable in the domain of sustainable finance. The 4 sections of the report are the ones along which we built the presentation of this morning, so that you'll follow us through the report as we speak. And Dariush, shall I leave it up to you maybe to start with tons of figures as to what are our thoughts and as to the ESG landscape by 2026.
Thank you very much, Fred. We decided to stand up. Frederick was very kind because I'm small, so you can see me better. Yeah. If that doesn't mind, and I think the light was a little bit also annoying me in my eyes. I'm a little bit older man. What do we believe? Where is the asset management industry going right now? Okay, so let's look at the past. And do I have a pointer? Is this black pointer? So I will just walk down here so you can see it for those who are present. If you look at this, you can see that there has been an increase of 8.9% compounded annual growth rate across the years from 2015 to 2021. That was a massive increase, right? Because we have seen that global assets, both in funds, mandates, but also in alternatives, from a very strong growth rate, growing till 2021. Now, why was this the case, right? Because money was cheap. If you look at it, the interest rates were low. Money was being flooded in the capital markets. We had that immense growth that started post-global financial crisis and has seen assets grow to $127.5 trillion US. Now, the interesting part is, how do we believe that in the next 5 years we will see the growth? And we believe that there is going to be a slowdown in growth as money supply starts to become a little bit tighter. Now, we have seen already the Fed hiking interest rates. If you are invested, especially in the technology stocks, you have seen what the impact of that is. And we have seen for the first time assets in Q2 falling also across Europe and the US for the industry. Currently, how we have done it, and this is not the basis of a survey, this is our own modeling of PwC at a global level. If you look at that, we currently expect that assets by 2026 will grow up to 157.2 trillion US dollars. Now, what are the base case scenarios implies? It implies that we will see a 20 to 30% correction in the capital markets due to the shift of the Fed and the central banks across the globe. And we believe that as we see that inflation is sticky and as we see the normalization of the interest rate of the yields by the Fed, we are not going to go back to a zero interest rate environment. The Fed has consistently said that the neutral interest rate or the neutral interest rate target is around 2.5 to 3.5%. So we will see right now going up to 4.5 to 5%, the interest rates hike of the Fed. Most probably the ECB will also follow suit, but not at the same levels. We have seen ECB already raising interest rates. We believe that those interest rates could go up to 2.5%. However, Europe does have some risks where it cannot increase interest rates as the Fed does, and also the inflation that we see in Europe has differences to the inflation we see in the US, where US is being driven through a strong economy as well as the energy prices. Europe is mostly through the shock of the energy prices that inflation is so high. Again, what will we see? We will see a strong growth in the alternative side. Going further, we do believe that there will be some shifts. We have seen alternatives, especially pension funds, moving into the alternatives realm. Given the low interest rate environment, we might see some shifts back into fixed income because of the high yields going forward. However, still we believe overall the private markets alternatives do offer a strong growth in the coming 5 years. If you look at it from a regional perspective, again, growth within Europe and US will slow down. Also in the other, what we call developing markets or less mature markets than Europe and US, we will still see Asia Pacific growing at a stronger rate compared to Europe and US and North America as such, Canada included there, and Latin America. But again, they come from a lower basis, so we will still see strong growth. And I have been asked the question, does that, if you look at it, the growth was not so high in the past years. If you look at it in the local currency and do not do the currency exchange, actually the growth has been very, very strong. It is just that their currencies have lost against the dollar. I will move on to the next part and I'll go through this very quickly. A lot of numbers to confuse you. That is the global AUM. As you see, we expect a 4.3% increase on the base case scenario. The mutual funds, passives, again, if you look at it, passives growing at 7.7% compounded annual growth rate. We still believe that shift from active towards passive is not completed. We will still see that shift going on, both on the mandate side as well as on the fund side. And then you can see on the alternative still a 5.3% compounded annual growth rate, which is pretty strong compared to 4.3%. Where will the money come from? The clients of the asset, these are your clients, the clients of the asset management industry. You can see pension fund assets through to mass affluent, all of them, the strongest growth, again, coming from sovereign wealth funds on the one side and from pension assets. why sovereign wealth funds always tend to invest anti-cyclic, which means that they will support governments as they go through that. They will try to push money as the money supply tightens. So we do believe that sovereign wealth funds will keep on investing in the market, as well as pension assets, which have gone down. But again, the flows that are coming, they come on a regular basis. So we will see that. With this, I hand over to you, I think. Yeah? Yep, there you go.
I guess so.
That's ESG. You are the boss of ESG, right?
I'm trying at least. I just need one check. Do I need that mic if I use that? Okay. Because I'm not as good as Dariush when it comes to numbers, so I still had to prepare and put my notes on the, yes, not right in the middle. So I see some of you in the room making some nice pictures of the screens. I believe it's on the screens and not of Dariush. You get all the information in the pack that we're happy to share with you anyway after the session. So looking at how we believe, or what we believe are the 10 ways to build the growth of ESG, voila, in the future. Let me spend a bit of time with you with sharing what has been said, what has been told by the asset managers and institutional investors that we interrogated. First point, or the first key item of those 10 ways that ESG is shaping the future is the role that ESG matters takes in the growth of asset and wealth management assets. In the past, and I will leave it up to you to read the detail that you have on the screen, but in the past, we've seen the growth of assets in the AWM space being very much driven by A, the flows, the inflows into funds and into mandates, and B, by the increase of the prices of the assets. And this has generated quite a big part of the historical growth that we saw into that industry. What we believe and what we're being told also by the people we interviewed is that those two criteria, being flows and increase of prices, is changing. And we see ESG matter being one of the key driver, being one of the key trigger for the continuous growth of the AWM assets. Yet, where we've seen in the past a compound annual growth rate of the AWM assets of more or less 9%, 8.9 if I'm right, where we believe this growth will land for the period between now and 2026 is rather at 4.5%. This is very much triggered by all the macroeconomic trends and the situations that we have for the time being. Yet again, this growth, where we believe, and what the study tells us, is that this growth will be much more driven by ESG matters and by ESG interest than the traditional engines for growth that we had in the industry so far. Second point that I wanted to share with you today is why is it essential to continue working and to continue considering these ESG matters in the ESG space? Investors tell us when we ask them that more or less 80% of them, so 79% to be exact, plan to increase the allocation in ESG funds, in ESG products within the next 2 years. You see on slide here the level at which that increase might happen, but there is a strong, very strong trend here so that investors will continue investing into ESG-related products. So again, very much building on what we have heard this morning, the introduction, sustainable finance and the sustainable sector, the financial sector, has a key role to play to continue investing, financing the real economy. While investors will continue growing their ESG products, what we see also, and that's rather the good news, is that asset managers plan at the same percentage to increase the ESG products that they are about to launch or are about to manage. Here we have more or less 80% of the asset managers who says that they will continue increasing the number and the intensity of the ESG products that they manage. What I believe is also interesting is that beyond the investors, when we ask asset managers, what are the triggers, what are the items that makes them enlarging that ESG product base? Asset managers tells us that consumers, so we, the broad public, the pressure from the market and from the society overall, and also the employees, is very much driving a strong growth into those products. So it's not only an asset manager versus investor relationship here that we see, but we see pressure from the society as a whole, from the various stakeholders that asset managers have to deal with, that helps that helps growing the ESG range of those asset managers. So that's the first point I find interesting on that statistics. The second point is that institutional investors, when we ask them whether they're rejected already certain products, or if they are keen or if they plan to reject certain products, if the products are not, or if the asset managers are not at the level when it comes to ESG, we have more or less 3/4 of the investors saying that, actually more, 80% of the investors, that says that either they're rejected already or they are ready to reject asset managers and working with asset managers if those asset managers are not strong enough, are not developed enough into their ESG approach. Another point linked to that statistic that is striking to me is that investors, and that's very a point that is very debated and challenged by for the time being, is that investors see ESG as an integral part of the fiduciary duty of an asset manager. So you might know, or you might have heard about all the discussions as to what an asset manager should be looking at primarily. Is it financial performance, like we used to consider the past, or ESG is also an intrinsic part of the fiduciary duties of the asset managers? Some asset managers might be saying, okay, we're just looking at the financial side of things, fine, yet those asset managers will have to pay attention to the fact that 3/4 of the investors told us that ESG is to be considered as an integral part of the fiduciary duty, so the take good care duty of the asset managers. So yeah, take good care of the duty of the asset managers when it comes to financial products. Moving on, what about the investable universe for ESG funds? There are a lot of discussions for the time being about stranded assets and potential stranded assets. Well, what we see is that 72% of the institutional investors want to consider that their asset manager ESG investment strategies is to be thoroughly analyzed before making an investment decision, so that ESG is becoming an integral part of the asset management value chain, so to say, so that ESG must be a very key point when selecting an asset to invest in. Where we see also a number of rising investable, I would call them opportunities. It's that flow between new regulation on one side, and you might think about the EU taxonomy on that space, but you might also think about the discussions that are happening around the changes and the evolution of the EU taxonomy when it comes to having more dynamic approach to favor transitional activities. Obviously, those new regulations, legislations that we see worldwide might trigger a certain reaction from market, from the public, where consumers might be looking for more and more financial products that are sustainable. Linked this with the investments that are done by governments on the long term. We all have in mind certain very specific investments as per that are done, by the various states and member states in the EU. So we strongly believe that those three items, so the new regulatory framework, the consumer pressure, and the government willingness to invest long term, will increase the number of eligible assets for an ESG purpose for asset managers. I'm happy to come back next year or in 2 years' time, looking at the Lux Flag team here to see whether that holds true. But that's really where we believe and what we hear also from the people that has been interviewed. Building on my comments on the fiduciary duties, so far, I'm just checking that I'm on the right page. Here we go. So far, the fiduciary duties, as I said, of an asset manager was very linked and very focusing on financial matters. Yet, there is still a number of asset managers, and it's more or less 60% if you look at the numbers, especially on the left-hand side, where ESG integration has been having a positive performance on the financial products. So you might have heard and you might have read certain number of statements, analysis, whereby there was a kind of financial performance decrease in order to accept the positive investment impact that ESG might have on the financial products. What we see here, what we hear from asset managers is a bit the way around. ESG integration is having a positive impact on the financial products from a financial performance standpoint, which obviously goes very much in the direction of combining those two fiduciary duties, financial performance on one side and ESG performance on the other side. What about, what about investors? Yes, institutional investors are looking for more and more ESG products, maybe because they need to, because of their own reporting regulations, requirements. But I believe that investors are pushing for more and more new ESG products because of that underlying societal trend of trying to invest for good. Yet, the demand is obviously much bigger than the financial products that are for the time being designed at ESG by asset managers. The investors, and the majority of them, are telling us that asset managers should be more proactive when it comes to developing ESG products. And we still have 30% of investors that are struggling to find the right ESG investment opportunities, which again demonstrates the space that is still out there for asset managers in order to fill that space of lacking of ESG products for institutional investors. Looking at the future, and you see the split per region, there is still a very strong trend, to launch new ESG products. Maybe in certain regions that trend is bigger and there's more impact than in others. It's no doubt that the EU Action Plan on Sustainable Finance is pushing for that for EU-based investors. Yet, we see still the majority of institutional asset managers, telling us that they are about to adjust the existing product range, and it's the vast majority of them telling us so, in order to incorporate and embed more ESG matters into those financial products. Yet, doing so might have a cost. And are asset managers willing to bear that cost? Are institutional investors willing to bear that cost also? The vast majority of the asset managers, I should start again with institutional investors. The vast majority of the institutional investors tell us that they are willing to pay a premium for ESG products, to have products designed based on integrating certain level of ESG commitment. What level of fees might be considered as extra, might be considered as a right premium? You see here on the slide, we still have the majority of the institutional investors that are saying that what they would accept as a premium is between 20 and 40 bips. And that's very much aligned with what asset managers moving on the right side are ready to charge in terms of higher fees in order to design, manufacture those ESG products. we have on one side more or less 80% of asset managers saying that they are about or they consider increasing the fees that they pay, and 80% more or less of institutional investors saying that they will be happy to be charged with a higher premium. Funny thing is that, or funny thing at least on my side, is that on both sides, if we look at the average of the premium, going a bit more into the details of the figures that you have on the screen, asset managers on average consider charging 35 bips more, and depending on the region, on the regions, institutional investors are ready to pay 33 to 34 bips. So the level of the premiums on the two sides of the spectrum are quite aligned. So let's see here again to what extent the lack of ESG products will be able to be closed and to be addressed in the future by asset managers. To attract new investments, and that's the fixed point. I'm checking time so at the same time. I see Isabel who told me yesterday that I have to pay attention to time, so I will do so, which means that you have to be short at the end. So the sixth key way that we believe ESG might be shaped in the future is that managers will have to make an effort to differentiate their ESG products and to demonstrate ESG performance. Demonstrating ESG performance might be achieved by having a kind of ESG performance fees, so having a fee for the asset managers that will be linked to the actual ESG performance of the product. Here again, a small majority of the institutional investors are ready to accept to pay an ESG performance fee, whereas 56 or almost 57% of the asset managers are considering charging that ESG performance fee. On average, the amount of the fee, as you see here on the slide, that is considered on one side and considered as acceptable on the other side is 3 to 5%. The next point, next way that ESG might be shaped in the future, and that's the one I prefer because that's what I'm active in, is that investors say they want more regulation. So you might say, well, we already have in the EU, at least the EU action plan, which is a bit complex to put in place, a very tiny bit. Both asset managers and institutional investors recognize that regulation might be a major obstacle when it comes to ESG growth. Yet institutional investors are still very keen to get more regulation, but more regulation in the sense of clear, simple, and less complex regulation to put in place. So no doubt also here that the current framework that we'll have in the EU with the EU action plan and the various evolutions that we have around that is to be simplified, at least in practice. Let's see how our friends from the Commission at ESMA might react on that one. What about here we go. What about the investments? And investments, meaning not only from an asset management standpoint, but how companies and asset managers are getting ready to build, design, maintain ESG products. There is a cost that is varying per region, but more or less, asset managers tell us that the cost for running and maintaining such ESG products amounts to 10 to 12% of their ongoing costs. Moving on, and very much to what we've heard just before by the Minister, the just transition towards a world that is more climate friendly, that is more social friendly also. That just transition requires the three dimensions of E, S, and G to be quite balanced in the way they are addressed in the ESG integration within the financial products. I will not start now the debate whether the good governance is a trigger for E and S dimension or whether the good governance is the output of proper investments into E and S dimension. But that transition towards a better world, a better functioning world, requires a certain level of balance, as said, between the negative impact that we see in accelerating a green transition with energy supply issues potentially, with unemployment issues, and also upskilling matters to be addressed, and on the positive side, taking care of the E&S emergencies that we have to face. All this needs, as said, a strong governance standpoint, so that the three dimensions are quite balanced. Last point I want to share with you as part of these 10 ways that ESG might be shaping the future is the labeling issue. And I think that's today the very nice and fair audience to address this point, being in the Lux Flag Sustainable Investment Week. Usually when we've seen greenwashing issues or mislabeling issues, it has been, in most of the cases, an unintentional base. So there is no unintentional action from asset managers to do greenwashing. Yet, what the asset managers tell us is that, yes, mislabeling is prevalent within the industry. And to address this issue of mislabeled, what they are looking for, what asset managers are looking for, is for more transparency, more clear guidance as to what are the labels considered. Here again, not looking at specifically the Lux Flag labels, but we are all in mind the actions that are taken at the EU level when it comes to the eco label for financial products, for example. So more labels, more clear labels, will, in the future, for sure, help in avoiding this mislabeling issue. On that note, those are the 10 ways that we believe ESG might be shaping the future on asset management. Darius, what are 5 minutes? 5 minutes. It's more than enough. What are the ways that businesses should be looking at addressing those ESG matters?
Oh, just before we go that, sorry. I'll take the...
No, you're not supposed to do so.
Yes, I know. I'll still, because that's an important point. You see, the one point is important is why. This is the global forecast for ESG. I talked to you about the normal forecast of 4.3%, right, growth from 2026, between 2021 and 2026. You look at the global ESG growth, that will be 12.9%. Now, admittedly, a part of it will be through retrofitting, okay? So a large part of it, but already 40% of new funds.
Darius, sorry,
Already 40% of new funds that are being developed, newly launched funds in Europe are already ESG, okay? So we will see that retrofitting wave go roundabout, stabilize in Europe in 2023, and then we will see the focus more and more on new product developments. Whereas at a global side, they are still lagging, so they will come up. I just wanted to point out the difference between 4.3% compounded annual growth rate and 12.9% compounded annual growth rate. So if you want to be in a growth market, ESG is where you need to be. And I'm running, don't worry. So, going back to that, those are the 4 steps we believe: set up a strategic integration, reconfigure your operating model, develop and convey a compelling story, and focus on the G. Now, we might differ on the G because we believe G, if you have a sound G, E and S will follow. But then again, that's a discussion within the industry. Very quickly, I think it is important when you as asset managers are sitting down and discussing it. It's a board level discussion on the first level. Who are you? What do you stand for? Yeah? Are you a skeptic? Or are you an opportunist? Or enthusiast? Or a strategist? Okay? I will just show the 2 sides. If you're a skeptic, right? If your board decides we don't believe in ESG, there is no sense of putting that much in, because that will decide on your product, on your operations, everything. So the board has to decide where, in which pot you are here, okay? because your products on an ESG skeptic side will be just as long as you suffice the regulatory requirements. On the other side, you can be an ESG enthusiast, right? You can say, I don't care about my strategy, about my corporate strategy. I don't care how much it costs. I am going towards the ESG, whatever it may be, yeah? Then your whole operations change. We believe the best is to be on the side of the ESG strategist, where you align your corporate strategy with the ESG strategy and look both at short-term wins as well as long-term wins. Again, this is a board level. You know all of this. I'm not going to repeat that one. I'm sure as asset managers, you have looked into it, but just to remind you on it, you have to first of all look at your stakeholders and communicate with your stakeholders. If your stakeholders is the Texas pension fund, well, that might be a tricky one, yeah? Develop a roadmap. You have to develop a roadmap, right? You have to think about it strategically. It's not just that I deploy a person as an ESG guy and then I'm suddenly ESG, yeah? A lot of the mislabeling comes from miscommunication internally, yeah? Because there is no strategic roadmap. There is no strategy behind it. You just put a team there and say, do ESG for me. That's not how boards should act as. Set the tone at the leadership level. Again, I'm emphasizing that point. You have to give that point. If the leader thinks, well, you know, some leaders, political leaders in the US don't believe in it. So how should all the others believe in it? If as an asset manager, the CEO, the management doesn't believe in ESG, then it's only lip service. It's not really acting on it. Remember, this is not an investment trend. This is a value shift. Investors are going to hold you responsible for, are you following ESG? And we are seeing it already, that shift in the Nordic. You can bring them a portfolio of ESG. They will ask you, show me your non-ESG portfolio. And how do you reconcile that both? So bear in mind, sorry, I'm wrong. Sorry. So bear in mind that this is not an investment trend shift. This is a value shift, and you will have to live it. We are currently in transition. 6 years down the road, you are not following those ESG. ESG is already the dominant investment part, right? And if you are not living that values, investors are going to hold you responsible for that. Set the tone and build on the momentum, okay? So, again, when reconfiguring your operating model, data, okay? Where do you get the data? How do you clean the data? How do you analyze the data? How is it embedded within the DNA of your company, okay? Understanding the data challenge and working on the data challenge is key. Here are some numbers, what asset managers believe and why institutional investors are still not putting all their money in ESG, because they need to understand that you are providing impact, or you are really, the ESG data is showing that there is a shift. Again, what are the KPIs that investors are going to ask for you? Definitely at the portfolio level. You are used to it. Sorry, I should be louder. I hold it lower because I'm always so loud, yeah?
It's for the people online.
Okay, sorry for that, yeah? I don't want to make people deaf. At the portfolio level and at the manager level. You see the manager level, so it's not only the portfolio level they are going to ask you for the ESG KPIs. They are also going to ask you at a manager level. What are you doing? What is your institution doing? Yeah. The KPIs, if you look on the right-hand side, your social KPIs, you see I am plan on requiring. You see that still a large number will be shifting towards that, as well as information on exposure to climate risks. That's the two big KPIs that investors are going to look at as you move forward. So you better up your game on that. Again, the G, the E, the G, E, S, E, and S, as you can see, investors are going to more focus. If you look on that side, next 24 months, you see that increase from 17.2% to 27.2%. There is clearly a shift in the investor's mindset that G makes the basis of E and S, okay, you need to have a good governance. However, if you look the products that are set out, still the focus is mostly on environmental in the next 12 months. So again, there needs to be a thought process of the engagement you are doing within your portfolio companies on the G.
And on that note?
On that note, I am done all through your whole operations from the RFP to internal controls. ESG has to be a part of it. Thanks a lot.
Thanks, Darius. So I do a bit of teasing now for our report because Darius and I have been talking way too long compared to what we planned. So the fourth part of the report that you can find online, and you'll find also an abstract in the documentation that will be shared with you after the conference, is a kind of 10-point checklist as to how your business should be ready. So I will not go through that now. It's a good incentive for you to try to look at the report and look at those 10 points. Any one question in the audience? No? Oh, so it's going to be for the break, sorry. Thanks a lot.
Thank you, Frederic. Thank you, Darius, for this remarkable study and for your strong statement towards ESG and to focus mainly on the good governance aspects. So our next section will start at 10, and it's hosted by Union Investment, Luxembourg SA, and focusing on ESG, Investing 2.0, challenges and solutions for investors.